Begin your financial journey by defining what financial freedom means to you in specific numbers. Identify the income you require and compare that to your existing assets. Achieving clarity is crucial. Unclear targets can make decisions seem arbitrary. Shift your mindset from consumerism to investing, even in small, regular increments. Outline the desired outcomes, then establish target numbers for each level of financial security. With clear targets, you can distinguish between your needs, wants, and long-term objectives without uncertainty. Determine the results you will not tolerate, such as excessive fees that diminish returns or risks beyond your comfort level. This foundational step establishes a benchmark that will guide your saving, investing, and spending decisions for years to come. This video is inspired by Tony Robbins' book, Money Master the Game, which provides deeper insights into these concepts. Subscribe for more videos that translate complex financial principles into actionable steps you can implement each week. Many investment mistakes stem from rules that prioritize intermediaries over your financial gain. The first line of defense is being aware of all fees, as even small percentages can lead to significant losses over time. Published performance figures can be misleading because they often overlook the nuances of real investor behavior. When accounting for both costs and behavior, investors often realize they retain far less than the reported market returns. Always request a straightforward summary of all fees, including fund expenses, advisory fees, and trading costs. Taxes are also a consideration, so favor strategies that minimize turnover and avoid unnecessary taxable incidents. Financial advice should ideally come from a fiduciary who is obligated to prioritize your interests. Protect yourself by steering clear of advisors linked to product sales or firms promoting their own funds. This approach leads to a clearer baseline, where performance is more influenced by market conditions than hidden fees. As you progress, build a system that automates savings and investments, guided by straightforward, low-cost principles. After setting your targets, create a saving structure that captures funds before they can be spent. Robbins advocates for an automated monthly plan that operates without requiring constant decision-making. One component should be a freedom fund to manage living expenses, leisure, and future priorities in distinct categories. This setup ensures each dollar has a designated role, preventing it from drifting into impulse purchases. Automation is vital because motivation can fluctuate, but automatic transfers ensure consistent progress each month. Increase the gap between your income and expenses by focusing on earning more, saving diligently, and controlling costs. Each enhancement translates into investable capital that can be directed according to your preferred allocation strategy. The fundamental principle is straightforward. Retain more of your earnings and let the power of compounding work in your favor. With this system implemented, investing transforms into a reliable process instead of just a one-time action. You now have the essential cash flow framework needed for enduring stability across various market cycles. The focus on asset allocation, rather than individual security selection, shapes most long-term investment results. Instead of treating your capital as a single entity, you categorize it into layers, each with distinct functions and risk profiles. The first layer is a security layer, crafted to safeguard essential needs and cover necessary expenses during market downturns. The next layer is a growth layer that strategically embraces risk to enhance long-term purchasing power. The final tier is a purpose layer, dedicated to the goals that are meaningful to you, ensuring that progress feels tangible as you invest. This bucket strategy minimizes frantic decisions, as it clarifies which funds can be utilized and which must remain stable. You allocate each layer according to your income aspirations and your comfort level with temporary losses. Once your allocation is established, the key discipline is rebalancing to meet targets instead of pursuing recent winners. Diversification among different asset classes is implemented to lessen dependence on any single economic outcome. Subscribe for more videos that simplify allocation strategies into straightforward principles you can easily integrate into your investment approach. A well-diversified allocation should be assessed by its performance across a range of environments, not solely in favourable market conditions. The book outlines a model portfolio with a proven track record of consistent returns and lower maximum drawdowns. The foundation is diversification across assets that respond differently to growth, inflation, and deflation. When stocks decline, bonds or other defensive holdings can help cushion some of the loss, reducing overall volatility. In times of rising inflation, assets protected against inflation can sustain purchasing power and decrease reliance on stock gains. The aim is not to chase the highest return, but to secure a return that you can maintain through challenging times without giving up. A smoother investment journey preserves your compounding progress, allowing you to sidestep the need for a recovery from significant losses. After selecting an allocation, monitor performance, expenses, and risk using consistent metrics. This underscores why the emphasis is placed on structure and discipline rather than continuous market predictions. The next opportunity lies in converting accumulated assets into dependable lifetime income as you approach your target. Investing represents just half of the equation. Assets cannot be spent, but cash can be utilized for living expenses. Once you achieve financial freedom, your focus shifts from the total account value to sustaining a lasting income. The strategy involves creating a lifetime income plan that transforms a portion of your capital into a reliable income stream. The objective is to cover essential expenses so that fluctuations in the market do not jeopardize your basic standard of living. This approach enables the remainder of your portfolio to remain invested with a longer time horizon and less urgency to sell. Be cautious, as financial products can differ significantly. It's crucial to carefully compare terms, costs, and guarantees. Seek clarity on fees and establish straightforward rules for how your income is calculated and when adjustments may occur. This step ensures that your target number aligns with the actual monthly cash flow you will rely on. Engaging in income planning early makes controlling retirement timelines and spending choices significantly easier. You now have a cohesive framework that links your targets, savings, asset allocation, and income design into one comprehensive plan. A financial plan is effective only if regularly monitored, because changes in fees, risk levels, and asset allocation can occur unnoticed. Obtaining a second opinion is advisable to scrutinize your holdings, the fees you're paying, and the risks you are accepting. This review reveals whether your current portfolio reflects the allocation you've set out to achieve and the results you desire. If you choose to work with an advisor, look for a fiduciary who operates independently without ties to brokers. Steer clear of proprietary products, as in-house fund recommendations may not align with your best interests. After the review, adjust your portfolio, minimize unnecessary costs, and revise your savings rates to stay on track with your targets. Schedule regular check-ins to address minor issues before they escalate into costly problems. Discipline lies in consistently adhering to the essentials, rather than attempting to predict market fluctuations. When you simplify your process and make it repeatable, achieving financial freedom becomes a natural outcome of your routine. Subscribe for more insights that transform complex financial concepts into practical steps you can implement right away.